Assalamu alaikum. Good evening. So, friends, we have seen in the previous, that is income tax 2, we have learned about the residential status, that is section 6 of the Income Tax Act 1961, wherein we have seen that um, residential status is based on the number of days physically you stayed in India. Correct? So for the individual and HUF, we have seen resident and ordinary resident, resident but not ordinary resident, and the non-resident. Now today we will discuss about the scope of the total income or the incidence of the tax. The tax will be levied. The tax will be levied by the income tax in India based on the income of the person. But the taxable total income is based on the residential status. So we know that now there are three types with respect to the individual and Hindu undivided family. We have three types of resident: a resident, ordinary resident, resident but not ordinary resident, and the non-resident. So all these depend on certain number of the days to be stayed in India. It is nothing to do with the citizenship or the domicile of any country. It's nothing. A person can be resident of India in 1 year and can be a non-resident in another year. That there is a possibility. Today we discuss, based on these three, which are all those incomes which are taxable here. So I'm going to explain you. We have resident and ordinary resident but not ordinary resident, and a resident. Okay, these three. Okay, any income which is defined under section 2 subsection 24 of the Income Tax Act, any income received in India, it is taxable in all the three cases: resident and ordinary resident, resident but not ordinary resident, and non-resident. In all these three cases, if it is received in India, it is taxable. Number 2, income earned in India. If you are earning the income in India, then it is taxable in all the cases. That means in all the three cases, all the three people have to pay the tax in India. Then the third step is income earned in India, whether received in India or received in the foreign country, irrespective of the receipt, it is taxable. He has to pay the tax in all these three cases: resident and ordinary resident, resident but not ordinary resident, and the non-resident. Okay, then income earned in India, income earned in India, whether received in India or elsewhere, it is taxable. Income received in India, whether it is earned in India or foreign, you have to pay the tax when you are a resident and ordinary resident but not ordinary resident, and the non-resident. All these three cases. Income accrue and arise outside India, from the business or the profession setup, but you are controlling that business or the profession from India, then two people have to pay the tax: resident and ordinary resident but not ordinary resident. In case of the non-resident, he need not to pay the tax in India. Okay. Now, income from the business or the profession outside India, not in India, outside India, control also outside India. Mean to say that the business is in Middle East, but you are controlling from the Europe. If you are a resident of India, then you need to pay the tax in India. In case of resident but ordinary resident only, in case of resident but not ordinary resident, and in case of non-resident, you need not to pay the tax. Okay, income deemed to be accrue and arise in India, income deemed to be received in India. So in these two cases also, you have to pay the tax when you are a resident but not ordinary resident but not ordinary resident, and the non-resident, you have to pay the tax. Now let's try and understand it that what about the gifts? If anybody gives you a gift, that gift is less than 50,000, then it is not an income, it is not tax. Any gift you received as a marriage gift or on a will or family partition, it is not an income, you need not to pay the tax. Any gift received over and above 50,000, that would be treated as an income, and all these three cases, resident and ordinary resident but not ordinary resident, and non-resident, all these three cases have to pay the tax in India. Any income received from any dividend paid by the Indian company, any dividend paid by the Indian company, its share to its shareholder, it is taxable in all the three cases. That is resident and ordinary resident, resident but not ordinary resident, and non-resident. Dividend from any cooperative society, taxable. You have to pay the tax even if you are a non-resident as well. Then any profit you receive from the Hindu undivided family, any member or co-partners received any profit from the Hindu undivided family, then it is not taxable because it is already taxed in the hands of the HUF, so it is not taxable at all. Now a question arises, what is this deemed? Income received we will understand, income earned we will understand, income deemed to receive, what is this? This is something unique which we need to understand it. Income accrue and arise, these two things are really required some amount of the understanding, right? So let me talk about the income deemed to be received. In section 7 of the Income Tax Act 1961, it is very clearly explained that what is income deemed to be received. See, we know that income received in India or income received, we understood we are getting the income and obviously we need to pay the tax. What is this deemed to be received? Deemed means assume. That means a question arises that should we pay the tax on the assumed income as well? It's a hard fact. Yes, you need to pay the tax on that because you are the beneficiary for that. You would be getting the money not necessary now, but maybe after your retirement, maybe after some period of time, maybe after the termination, you would get that amount, and the tax liability cannot be postponed at that point of time. You have to pay the tax when there is an income deemed to be received. Okay, what is this deemed to be received income? Let's try and understand it. You know that Provident Fund. If you are working in a company, there will be a Provident Fund. Both employee and the employer make the equal contribution, and that Provident Fund you would get after the retirement, or some specific cases, in case of the marriage, hospitalization, and in some kind of the emergency, you can withdraw the amount, both employer's contribution and employee's contribution. You can withdraw it, correct? Okay, if you contribute the money to the Provident Fund, it is not an income. When the employer contribute up to 12%, it is not an income. If employer contributes to your Provident Fund over and above 12%, then that excess, for example, employer contributes 15%. So 15 minus 12, 3% of such contribution, you have to pay the tax on that because you would be receiving that amount at the later point of time. Then any interest credited by the Provident Fund in excess of 9.5%, you need to pay the tax on that. Okay, and any transfer balance from unrecognized provident fund to recognized provident fund, you have to pay the tax on the whole amount. Employer contribution to any pension fund of yours referred under section 80 CCD, you have to pay the tax. Okay, now these are all the income deemed to be received. Now income deemed to be accrue and arise, what is this? You are receiving the income, earning the income from any business which has the connection from India. It is deemed to be accrued. You have to pay the tax. Any income from the house property situated in India and you have received, then you have to pay the tax. Any income from any other source or any asset which is situated in India, you need to pay the tax. Okay? Any capital gain if you transferred from the transfer of the capital asset which is situated in India, you need to pay the tax. Any salary you have earned in India, it is deemed to be accrue and arise. Any salary paid by the government for the people who are working in abroad, working outside India, it is taxable. Then any dividend paid by the Indian company to the non-resident, it is an income, you have to pay the tax. Then any royalty payable by the government, resident, non-resident to the outside India, it is an income, you have to pay the tax. Any technical fees paid by the government or the resident of India to outside India, it is treated as an income, you need to pay the tax. Okay? Any income or property transferred to a non-resident outside India or a company, in such case also, it is treated as an income, you have to pay the tax. So we have learned two things now, section 6, section 5. Section 6 in the part 2 and this is part 3 of our income tax. So we have learned that residential status, if you stay for some specified period of time, you will be classified as resident and ordinary resident but not ordinary resident and non-resident. Then if you are categorized into these three, certain incomes are taxable for non-resident and but not ordinary resident, certain incomes are not taxable. So certain gifts are taxable. If the gift is over and above certain amount, it is taxable, otherwise it is not taxable. Certain incomes are like employer's contribution to RPF, recognized provident fund, interest credited on RPF in excess of 9.5%, this is deemed to be received. Certain incomes are deemed to be earned in India, assume, like any property, any business, any source, any asset stayed in India and you are getting the income from that. And any income paid by the government to the people who are working outside India, it is taxable. Any salary paid outside India, it is taxable. So any amount or any asset transferred outside India to a non-resident individual or the company, in both these cases it is taxable in India. Okay, so in this part, that is part 3, it is the scope of total income and we will learn section 10 or section 10, that is the exempted incomes from the total income. We will learn about this in our part 4. Thank you so much. Keep watching it. Thank you.